There are hundreds and even thousands of good quality stocks that you can pick, but just picking a stock based on its quality is not the right thing to do if you want to maximize your profit, because the stock price is usually matching or overhyping the stock value. So by the time when you're buying, the stock is already overpriced. So the best thing you can do is look for the signal, not the stock. And that's what I'm going to talk about right now. What is the strategy that'll help you grow beyond 100,000 plus portfolio? Things that I'm doing, things that I'm learning, and so on. So I'm gonna share my screen. And the goal, as I said, is to pick the signal and not the stock. Sometimes, and most of the times, you will see that the stock is priced correctly and even overpriced. But the best thing you can do is wait for the dip, wait for people to start selling and oversell, and that's when you buy. And how you do it and how you predict that is with a signal, nothing else. So if you know how to look for signals and read the signals, you know how to predict the price of the stock. So some are built for long term, some are for short term prediction and profit. You can use both, and the best traders know how to do both. And you can combine buying stocks, selling stocks, buying options, and selling options. And that's what I do. You can predict those through patterns, data and cycles, and you cannot predict it beyond its current context. So you only should know what you know and not go over analyzing and reading what is just not possible. The astrology for stock trading doesn't exist, if you know what I mean. But if you know how to read the data, spot the patterns and cycles, you'll know how to pick the stock. And here's how to read the long-term signals. So the long-term signals are the ones that show what is the true value of a stock. So usually the short-term ones are more hype and momentum and things like that. But the long-term signals are more determined by the quality, because if you're going to hold a stock long term, you want to know that with time it's going to win. It doesn't matter if it wins right now, but it's important that it wins for sure. And those are revealing what's going on with the stock. So one of the main long-term indicators of companies' quality is earning per share comparison and consistency over time. This metric basically compares total earnings divided by total number of shares, and it's if it's growing and if it's consistent over time, that means that the stock will increase proportionally because the value of the company will grow as well. Usually, if you already see the earnings, the stock is already priced correctly. But if you project that the whole industry and the company is doing well, you see the contracts, you know, based on what you see out there that the company will overperform, then you should probably buy shares or go long, buy calls. Now, usually if the company doesn't overperform, it doesn't mean it will jump in value, but it could mean that the options will grow in value. So one doesn't mean that the other won't happen. So you still have good, so you can still have good strategy with buying calls if you just don't buy shares. And for long-term signals, this might not be the best case scenario to buy options because they're short-term. But if you're looking for long-term and you believe that the company and the industry will grow and the leaders, the team knows what they're doing, then you should buy a long call or shares. Then the next one is earnings growth, margins, depth, innovation. Now, if you know how to read the balance sheet, the P&L of the company, if you understand the industry, and you should never invest into something you don't understand. I usually invest in a lot of my money in tech because I'm just interested in tech right now, AI, data centers, energy, and anything connected to AI basically. And if you know how the balance sheet should look like in that industry, for me it's easy. I'm in business, or it's easier. I know how to look at a company. I know what is important, so I can put myself in the mind of the leader and understand what's important. And when I'm reading the sheets, I get it. I know that, for example, if there is a drop in Tesla, I know who's leading Tesla and how many smart people there are. I can even guess that they will figure out the way out, and even though the numbers are not the best at the moment, they'll figure it out. Next thing is PE ratio trends versus sector average. Now, of course, company will probably, if they do the same activities as anybody else and the sector average is 25, and right now their PE is 14, probably it will go up to 25, and based on that, you can determine where the price is gonna go. Then you have ETF. For example, I'll give you just an example of what happened with Palantir recently. Palantir's PE is whatever 180, but the reason why it's so high is because people project that this company is going to increase its profits massively. Now, if you want to compare it to its sector average, there's no sector average. Or basically, the Palantir is maybe the only stock that currently can do what they are doing, and that's why it's priced so high. But if you, for example, compare AT&T and Verizon, they'll probably have around 14 PE. If the PE drops to 6, you should definitely buy it. UnitedHealth management recently had a PE of 9 or something like that. It dropped from 600 to 230. Now, Warren Buffett invested in that company, and the PE and the price of the stock increased, and the PE increased accordingly. So that's something that you can look at as well. Why it's cool? Because just think about it from the logic perspective. If a company is so profitable that it can basically pay off by itself, and that's how I determine like PE. If it's 9, means in 9 years, if it just keeps the profit, it can buy itself. And that's the easy way for me to translate it. So if my company earns so much, and in 9 years I can buy my own company, that's a pretty good result. I would like to own that company, and that's how the investors should think about. Now imagine, even if you buy the stocks and the stock drops, like that's even better. You should buy more. If there is nothing wrong in the company and the PE is so low, that's the best indicator for me at least. Next thing, and last thing for long terms are industry performance drivers. So policy, technology cycles, global demand. That's basically NVIDIA. All right, now that we know how to spot long-term signals, you gotta know also that you can earn a lot of money with short-term signals. What I mean is companies that you're not planning to hold, something that is just happening right now in the market, and you can utilize that to earn money. And this, for example, is pre-earnings momentum. Like, for example, every company releases earning reports. If you know the date, you can prepare for that. And if you know what's going on overall in the market, you can utilize that and earn money, as I mentioned before, on the momentum. It doesn't mean that it doesn't mean that you will earn or lose money if the stock goes up or down, but if you know how to use the options might go up and down, even though the stock won't move much, and that's the way you can earn without risking much, because options have a predefined stop loss, and that might be a smart move for you. And then you have AI-based earning predictions. AI is booming right now. Almost every company that I see that announces some kind of AI partnership just explodes. You can track that. You can track post-earning dips and rebounds. For example, if a company has bad earnings and it drops like 20-30%, that looks like crazy amount, and there might be a reason. And if the team is good and if everything is good, why wouldn't you buy it or go long? Because maybe just the valuation doesn't make sense. Then you have momentum trades, where you just look at the volume and volatility confirmation. If you know how to read the charts, if you know how to see where the volume is, who is trading, how much they're buying, and you can see those momentum trades. For example, POWI recently had this, and almost every stock in the AI had this momentum where everybody starts buying, everybody goes crazy, and the stock explodes. Then you have politician trades and insider disclosures. Probably you heard of Unusual Whales. It's a site that checks the volumes of crypto and options and stocks trading and looks for irregular trades. You probably heard of Nancy Pelosi as well, and traders or politicians who buy a lot of stocks. Some traders just follow what they buy and just buy after them. That's also wise. You can do that as well. You can look at hedge fund positions and look for those social sentiment, media hype. If there's tons of people talking about a certain stock, like for example iron is also in AI, in energy, you can look at iron, like tons of big names in social media and influencers talked about it. You could have predicted that, you could have traded that. And there is IPO and new listing hype. There are not many companies that go into IPO and decide to do that. The IPO hype or the number of companies that go through IPO is dropping because there are many other options nowadays. But the ones that are connected to to cryptocurrency usually explode. You can see a couple of examples this year, like Circle and Galaxy, and the last 2-3 years, all of them have grown as to enormous amounts. And the last one is options flow pressure, the unusual call and put activity. As I mentioned, you have unusual whales, and you can measure then the volume in calls and puts, and that might be a signal for something is going on. Now that you know long-term and short-term signals, what if there is no signal? You're just trading, let's say 20-30 stocks. When there's no clear signal, what do you do then? Well, for example, in my last 2 videos, I explained what to do to grow your portfolio to 100K. You just follow the same strategy, stay disciplined, don't change anything. With more time, hold growth or risk positions. So if there's no signal, just continue holding growth or high risk positions if you have more time. If you have less time, hold safe and dividend positions. What does that mean? It means if you have long time, it means that you're young, you don't need money right now. You can risk a little bit because you'll earn money on the way anyways. Then you hold higher risk positions. If you have less time and you want to earn, let's say you want to earn consistent income, risk less, because you're already close to retirement, just hold safe or dividend positions. For short-term setups, just use cash, stay liquid, use options. Options are a great way to define the risk and the investment. Basically, if you buy calls, the stop loss is always defined by the premium. You don't need to figure it out, and the maximum risk is your premium. That's an amazing vehicle for you to earn a lot of money. I'm going to talk about this in the next video. And the last tip is keep learning. If there is no signal, just keep learning. Be patient, be disciplined, follow the strategy. You don't need to do anything. If you do all these things properly and you follow those rules, you're going to be in a position where you're going to have higher than average returns anyways, and you're not going to be forced to trade. If you earn, let's say 15% in a year, 20% in a year, that's already amazing if you do it consistently. Now, if you are already at 20%, it's just June, and you still have time until December, nothing bad is going to happen if you don't trade in July and August. Take time, look for something that's obvious. My best trades were super obvious. Like, for example, UnitedHealth management falls down from 600 to 230. Amazing business, just the leadership was a little bit bad, made some bad moves, and it was obvious that it's going to recover. It's too big to fail, and Warren Buffett invested into it, and the stock grew and it's still recovering, but it's going well. All right, that's the video for now. Now you know what to do with long-term signals, short-term signals, and when there is no signal. Now, the next thing you need to do is understand how to find those signals. Now, if you just focus on one of those strategies and figure this out, don't go to the next one until you figure this one out. When you figure it out, you can go to the next one and just figure and just make sure that you see what you like. Focus on just a couple. With time, you're probably going to be able to do all of those. Some of those require full-time engagement, or you can hire somebody. You can do it yourself, but you're just going to notice that some of these occur whether you see them on social media or by accident, and then just see what makes sense for you. If you like it, if you don't, never risk more than, let's say, 1% or less than 1% on short-term signals. Long-term signals, just buy quality companies. Just follow those rules you will see here, and in the next videos I'm going to talk about this in more detail. Thanks for watching, and see you.